What's good, everyone? Nicole Casperson here, and welcome to another edition of News Bites, a Yieldstreet times What the Fintech collaboration. Today I'm weighing in on timely fintech news and trends you should be paying attention to. In this episode, we are going over Fannie and Freddie Mac making reforms to address inequity in homeownership. Apple is set to introduce its own integrated buy now, pay later platform. And overall, just staff cuts in fintech. Let's dive in. I'm Nicole Casperson, fintech journalist, and this is What the Fintech. Fannie Mae and Freddie Mac are making some big reforms which aim to address inequality for homeowners of color. Fannie Mae and Freddie Mac are major players in the U.S. mortgage industry, in connection with the Federal Housing Administration and Department of Veteran Affairs. They support 70% of single-family mortgages. The reforms include offering lower mortgage insurance premiums and assistance with down payments, as well as devising a new credit scoring system which takes into account rental payments. Because home ownership is such a crucial way to build wealth and lift families out of poverty, Fannie Mae and Freddie Mac's initiative signals an impressive commitment to democratizing homeownership and addressing some of the real inequalities within the finance industry. Apple is launching its own buy now, pay later facility called Apple Pay Later. The service is due to drop in the iOS 16 update, which will be released in September 2022. The new feature means users will pay 4 installments over 6 weeks, with the first payment at the moment of purchase, and then every 2 weeks afterwards. This new addition enhances Apple's seamless user interface and will likely allow them to reach deeper into the merchant sector, putting Apple in direct competition with established buy now, pay later services like PayPal and Square. Not to mention, the more services Apple offers, the greater its ability to maintain its infamously tight link with its users' identity. Apple is underwriting the costs of its own buy now, pay later loans using their $50 billion of cash holdings. While buy now, pay later underwent an enormous growth phase in 2021, this was likely due to the pandemic and a 43% increase in online shopping in 2020. But we're already seeing that huge growth curve drop off. The global economic downturn is hurting fintech as soaring inflation stops tech companies from being able to scale. Klarna has cut at least 10% of its staff, Tesla has done the same, and insurtech giant Policy Genius has now cut 24% of its staff. Public spending is dropping, and supply chains respond by upping their prices in a bid to survive. Recent reports suggest that US-based tech and crypto businesses cut more staff in May than in the last 4 months altogether, and companies like Coinbase have officially ceased hiring for the foreseeable future. In a sharp departure from the glowing reports of tech and crypto expansion and progress in recent months, more than 4,000 jobs were cut in the tech industry in May. This is in comparison to just 500 job losses in the first 4 months of the year. More than 1,000 of these lost jobs were in fintech. All right, fintech fam, that does it for this edition of News Bites. Thank you to our friends at Yieldstreet for collaborating and to our listeners for tuning in. If you love this episode, be sure to hit that subscribe button. Feel free to give me 5 stars. You can find me on all your favorite podcast platforms. Until next time, talk soon.